Hey everyone, welcome back to Corporate Decoder. Today, S.M.B.W just filed its quarterly report, the 10Q, and I am seeing some interesting shifts in their loan portfolio. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is navigating rising interest rates while also seeing a jump in loan growth, which is a careful balancing act. Let's dive into the numbers and see what they tell us. So first off, we are looking at Security Midwest Bancorp Incorporated and its subsidiaries. They file a 10Q report, which is basically a quarterly checkup on how the company is doing financially. This report covers the period ending the 30th of June 2026. Let us start with the balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. On the 30th of June 2026, their total assets were about $244 million. That is down a bit from around $256 million at the end of 2025. One big reason for this drop is that their cash and cash equivalents took a significant dive. They went from about $50 million at the end of 2025 down to just over $20 million by the 30th of June 2026. This is a pretty big chunk of cash gone, but here is where it gets interesting. While cash went down, loans receivable went up. They increased by about $18.5 million, reaching over $137 million. This tells us they are putting more money into lending. Their investment securities also saw a small decrease from about $76.7 million down to $75.6 million. Now let's look at where the money to make these loans is coming from. Deposits, which are the backbone of any bank, decreased by about $12.1 million, falling to $184.4 million. This means fewer people and businesses are keeping their money with them compared to the end of 2025. To help make up for that shortfall and fund their loans, they have kept their borrowings from the Federal Home Loan Bank steady at $35 million. Shareholders' equity actually increased by about $1.1 million, reaching $23.7 million. This is good news and is largely thanks to the company's earnings. Moving on to the income statement for the 3 months ended the 30th of June 2026. Net income was about $390,000. This is up from about $350,000 in the same period last year. So overall, they are making more money. Interest income from loans saw a big jump of over $468,000. This makes sense because they are lending out more money. Interest on investment securities also nearly doubled. However, their interest expense also went up significantly by about $340,000. A big part of this is due to interest on borrowings from the Federal Home Loan Bank, which they did not have in the same period last year. This all resulted in a healthy increase in net interest income, a key measure for banks. It went up by about $418,000. They did set aside a little more for potential loan losses. The provision for credit losses was $24,000 this year compared to $9,000 last year. This is a very small amount and shows they are not seeing a huge increase in bad loans yet. Non-interest income, which includes things like fees for services, saw a decrease of about $83,000. This was mainly because of changes in how they charge fees on certain accounts. Non-interest expenses like salaries and operational costs went up by about $246,000. This is a significant increase. A big chunk of that increase is in salaries and employee benefits, which went up by over $136,000. They mentioned this is due to hiring more people and costs associated with their new employee stock ownership plan. Professional fees also jumped up by $42,000. They attribute this to the cost of being a public company. Now, despite the higher expenses, their income before taxes still went up, thanks to that strong net interest income. Now looking at comprehensive income, this includes those unrealized gains or losses on investments. For the 3 months ending the 30th of June 2026, they had a nice unrealized gain of about $495,000. A big part of that is from their available for sale securities where they saw unrealized gains. They also had an unrealized gain on a cash flow hedge, which is a financial tool to manage risk. Looking at the shareholders' equity over the 3 months ending the 30th of June 2026, you can see net income added to retained earnings and also other comprehensive income. Let us talk about the loan portfolio itself in more detail. They break down their loans into different types. The net loan balance grew to over $136 million, which is a significant increase of nearly 16% from the end of 2025. Their biggest loan category is commercial real estate loans, which make up a substantial portion of their portfolio. Construction and development loans also saw a slight increase. Commercial and industrial loans, which are loans to businesses for things like equipment purchases, also grew significantly. Importantly, their allowance for credit losses on loans as a percentage of total loans remained very stable at around 0.85%. This suggests they feel confident in their ability to collect on these loans. Non-accrual loans, which are loans where borrowers are not making payments, are also quite low. At the 30th of June 2026, non-accrual loans were only about $219,000. This is a good sign of healthy loan quality. They use a risk rating system, and most of their loans are rated as pass, meaning they are considered safe. Loans rated substandard, meaning they have weaknesses that jeopardize repayment, are very few. Let us look at their investment securities. They have a large portfolio of available for sale securities, totaling about $75.6 million. A good portion of this is in municipal bonds, both taxable and non-taxable. They also hold a significant amount in residential mortgage, backed securities, and collateralized mortgage obligations. When it comes to valuing these investments, they mostly rely on level 2 inputs. This means they use market data that is observable, like quoted prices for similar securities. They have no level 3 investments, meaning no significant unobservable inputs are being used to value their portfolio. They are also using derivative instruments like interest rate swaps to manage their risk. This helps them hedge against changes in interest rates. Now, for market risk management, this is basically how they handle the risks that come from changes in interest rates. They analyzed how changes in interest rates could affect their net interest income. The tables here show that if interest rates went up by 200 basis points, that is 2%, their net interest income would actually increase by about 5.66%. This is a positive sign, meaning they might benefit from rising rates. However, if rates went down by 200 basis points, their net economic value, or EVE, which is a measure of their long-term value, could decrease by over 11%. This shows they are more vulnerable to falling rates. Let's talk about liquidity, which is how well they can meet their short-term financial needs. Their primary source of funds is still deposits. At the 30th of June 2026, cash and cash equivalents were about $20.3 million. This is lower than we saw earlier, but they also have investment securities that can be sold if needed. They are committed to maintaining a strong liquidity position and believe they have enough funds to meet their obligations. On the capital front, the bank is considered well capitalized. They are well above the minimum requirements for things like common equity, Tier 1 capital. Finally, a look at earnings per S-Hair. For the 3 months ending the 30th of June 2026, basic earnings per S-Hair was 47 cents. For the 6-month period, it was 97 cents. This shows they are profitable. So what is the story here? Security Midwest Bancorp is actively growing its loan book, which is good for revenue, but it means they need more funding, which is putting pressure on their deposits. They are managing this by using other borrowing sources like the Federal Home Loan Bank, and seem to be handling interest rate changes relatively well with their hedging strategies. Their loan quality appears strong with low non-performing and substandard loans. The increase in expenses, particularly salaries and professional fees, is something to watch as they operate as a public company. The main risk I am watching is their reliance on deposits, which decreased this quarter. If they can't bring in enough new deposits to fund their loan growth, they might have to rely more heavily on more expensive borrowings, which could hurt profitability. What I am actually looking for is continued loan growth without a significant increase in loan losses and a stable or growing deposit base. Alright, that is our breakdown of Security Midwest Bancorp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded.